This is how EHang's price to tangible book value compares to the other publicly traded air taxi or advanced air mobility companies. So, one of two things. Either EHang is overvalued or it is doing something different that would justify this gap in valuation. In other words, when we put EHang on charts with the other air taxi companies, are we comparing apples to oranges? Let's find out. And let's start with the range of the aircraft. EHang's aircraft has the smallest range of all, 19 miles. EHang's aircraft is required to fly within visual line of sight of a ground crew, a requirement that is not needed for the other companies. EHang's aircraft is limited to 400 feet above ground level, not the case of the others. EHang's aircraft is restricted to flying above sparsely populated areas, therefore excluding urban environments. EHang's aircraft is not a transport category aircraft. It is certified in the unmanned systems category, which is used for drones. The transport category is more stringent, and all the other companies are pursuing a certification in that category, not in the drone one. EHang's type certificate has been issued by the Chinese Aviation Authority and would most likely not receive an equivalence from the US or Europe. All the other companies are pursuing a certification either with the US or with the European regulatory bodies, and in many instances, with both. So it's clear that EHang is not in the same category as the other publicly traded companies. It is in its own bubble. Here is a summary. EHang's aircraft is a two-seat drone required to fly below 400 feet within visual line of sight and over non-urban areas. The others offer a four-passenger aircraft able to fly up to 5,000 feet over urban areas. But then the question becomes, is EHang's endeavor more or less valuable than that of the others? Well, it depends on the market opportunity. EHang may well be in a market where there is an infinite demand and where they are the only company on the supply side. Their order book should reflect that if it was really the case. Let's look at the orders then. Eve Air Mobility has more orders, and Vertical Aerospace is almost at the same level as EHang. So, in whatever market EHang is, it seems to be smaller than the urban air mobility market. Then, what could possibly justify their value? Their unit sales price? Let's look at it. Now they're no longer in a bubble of their own. Their aircraft is up for sale for $300,000. Vertical Aerospace is priced at $4 million. Archer is selling for $5 million, and Lilium $10 million. Let's use these numbers to compute two new metrics: the enterprise value over the value of all firm orders, and the enterprise value over the value of all orders, including optional ones. Two metrics, two bubbles. In essence, EHang has a less capable aircraft. They have less sales volume, and their sales price is a fraction of the competition's. Enough beating a dead horse? Is EHang overvalued? You'll have to answer that question for yourself. But for me to put my money in EHang instead of US alternatives, I will need a steep discount to hedge against four things. Number one, the fact that EHang is incorporated in the Cayman Islands. As a foreign private issuer, EHang is exempt from many NASDAQ corporate governance standards. The company primarily adheres to the Cayman Islands corporate law, which has fewer or differing requirements compared to the stringent NASDAQ regulations applicable to US domestic issuers. For example, the Cayman Islands law does not mandate that a majority of the board is comprised of independent directors, or that there is an independent compensation committee overseeing the CEO's compensation, or that the CEO and the directors' board members disclose their compensation. Number two, the fact that the founder, chairman, and CEO still owns 34% of the company and that the institutional ownership is low. The retail investors are completely blind to what the founder is doing with his shares and with the governance of the company, especially exacerbated by the incorporation in the Cayman Islands, which does not help with transparency. The retail investors, which I assume being mainly American investors, are really at risk here. Number three, the fact that in China, CEOs and wealthy people tend to disappear without prior notice. And number four, just a general lack of transparency and foreign investor protection when conducting business in China compared to the US. Here's how EHang compares now to the US alternatives on the price to tangible book metric. This is how the price to tangible book comparison should be for me to consider an investment in eHang. I believe this may offset the risk of investing capital in eHang instead of Joby or Archer. Anything away from this does not make sense to me from a risk standpoint. As an investor, I am first worried about how much I may lose before dreaming about how much I may make. Consider subscribing to the channel and see you in the next video.